Welcome to the Veterinary Financial Podcast, where we discuss financial freedom and professional success. I'm Meredith Jones, a veterinarian and financial planner for vets. Today, we're talking about the student loan tax bomb. We're getting a ton of questions about the tax bomb, especially right now as vets are rethinking their repayment plans and long-term strategy for their student loans. I'm going to walk through some of the questions we hear most often, what's changed recently, and how to think about planning for the tax bomb in a way that's realistic for you. A lot of borrowers right now are revisiting their student loan plans because Save is being phased out soon, Pay is being phased out later. Borrowers' defense denials, for those of you Rossies out there, some of those denials are coming through for people who submitted applications for that lawsuit. And a lot of people just in general are being pushed, of course, toward the IBR plan or the future RAP plan when it comes out because they are having to transition off of Save. And anytime a repayment plan changes, the projected forgiveness amount often changes too. And when that changes, the projected tax bomb usually changes with it. One thing we're seeing frequently is that vets who expected a very large tax bomb under Save or Pay are surprised to find that projections under especially the old version of IBR or the RAP plan are often lower. That alone can shift how aggressively or conservatively someone needs to plan for the tax bomb, that tax implication at the end of student loan forgiveness. And so that's a common thing that I'm seeing is people say, oh, well, I was told that I was going to owe over $100,000 for the tax bomb. And now you're telling me that I really only am going to owe a smaller amount than that. And it's because on Save or on the Pay plan, some borrowers were expecting to get a larger amount of their loans forgiven versus on old IBR or the RAP plan, they're either going to have a longer timeline and or just have larger payments and therefore get less of their loans forgiven and therefore have a lower tax bomb. So it's really important to know what your numbers are and know how aggressively or conservatively you may need to plan for that. And many people haven't started to invest for the tax bomb yet at all, and they just have no idea how much they need to save for it. That's really common. So if you're in that boat, you're not alone out there. If you've been on the Save forbearance, even if you already know which plan you're going to switch to, or if you've already switched plans, it can be worth revisiting those numbers so that you know how much of a tax bomb you need to plan for. And if you're already on IBR or Pay, the other thing that I'm seeing a lot in consults is that a lot of vets, their income has dramatically changed since the last time they had calculations done for the tax bomb. And so you may owe a lower or higher amount for the tax bomb than you think, unless you do those calculations again or have them done for you on a consult. One common question that we get is, did they extend the COVID rule where forgiveness wasn't taxed? During COVID, federal student loan forgiveness was temporarily excluded from taxable income. That provision expired at the end of 2025. As things stand today, most non-PSLF forgiveness will again be treated as taxable income at the federal level. So that's the baseline assumption that borrowers should be planning under. So we need to plan as if we're going to have a tax bomb. If we find out later that they changed the law or something else has changed that makes it so that you don't have a tax bomb, ultimately, then you can stop being concerned about it. But the baseline should be planning for any loans that get forgiven to have a tax bomb. And of course, most veterinarians are in the what we call long-term forgiveness track, where they're not going for public service loan forgiveness. So when I was talking about PSLF, that's public service loan forgiveness. You're only eligible for that if you work for a government or nonprofit for 10 years, at least 30 hours a week. And so the majority of veterinarians who are going for forgiveness with their student loans are going for that longer term forgiveness that happens over 20, 25, or 30 years. And so it's really important to plan for the tax bomb for those folks. There's a narrow exception that we'll cover later for people who were supposed to reach forgiveness in 2025, but are facing processing delays. And so in general, how does the tax bomb actually work? So when taxable forgiveness happens, the forgiven balance is treated as income in the year that the forgiveness happened. So you would receive a 1099-C, which is a cancellation of debt, and it's reported on IRS Form 1040, Schedule 1. So that's the way that it actually works. A few states also tax forgiven student loans. Planning for that is important as well. Another very common question we get is, should I just save for the tax bomb in a high yield savings account? The answer for the vast majority of people is no, absolutely not. Student loan consultants, including ourselves, we have a tendency to say save for the tax bomb. And so a lot of vets don't realize that they should actually be investing for the tax bomb, not saving for it. For most borrowers, forgiveness is still many years away. So in that situation, holding money in cash for a long period of time can actually work against you. And it's much better to invest so that that money has more opportunity to grow over the long term. So it's similar in some ways to saving for retirement, where money that goes into your 401k or your simple IRA with your employer, that money isn't just going into cash and being saved. That money is being invested. So it's a similar concept for the tax bomb for those of you who have a tax bomb that is 10, 15, 20, 25 years down the road. And so we've shifted our language, and now we talk about investing for the tax bomb rather than saving for it. So for longer timelines, preparation usually involves opening a taxable brokerage account. So this is a non-retirement investment account, and investing that money in diversified funds. So a diversified investment approach aligned with the expected forgiveness date and your risk tolerance. And so that's something that you can talk with a financial planner. It usually leads us to follow-up questions like, what type of account again? How do you open one? What should you invest in? I'm talking about a brokerage account, so a non-retirement investment account. So that's the type of account. And you've always got options. So I mentioned financial planner. That's not the only way to have a brokerage account. You can open a brokerage account yourself with a major custodian, and you can invest that money on your own. You could use a robo-advisor. So that's another option that is out there for you. Or you can work with a financial planner and have them talk with you about their investment approach and talk to you about risk tolerance, then come up with an investment strategy that works well for you and take that off of your plate. So it's not something that you're having to manage moving forward. The vets I've worked with who are the most successful investing for the tax bomb, they automate monthly contributions to a brokerage account, and the account is set up so the money is automatically invested. If you want to kickstart your savings, you could start with a lump sum and then add to the brokerage account monthly after that. The way that those calculations are done, so when we do student loan consults or when we talk with our financial planning clients about the tax bomb and how much to save for it, we have a student loan calculator that we use to figure out how much forgiveness is expected, how much are they going to need to save for that tax bomb in total, and then also calculate how much they would need to save on a monthly basis to get there. Brokerage accounts to save for the tax bomb, they're one of the most common accounts that we help our clients with. High yield savings accounts, so let's revisit that. It would probably only make sense if forgiveness for you is coming in the next year or two or maybe 3. Otherwise, investing for the long term in an investment account rather than a savings account is what I would suggest. Another common question, this comes up surprisingly often, is can I just have no income the year forgiveness happens? And some people think, okay, well, if I have no income, maybe they won't make me pay a tax bomb. The tax bracket that they would use for the tax bomb is based on your income in the year the loans are forgiven. So in theory, a very low income year could reduce the taxes owed. But in practice, is that something that's really practical for you? It's also a difficult approach to rely on. So, of course, you still need income to live. Forgiveness timing is often unpredictable. So right now there are processing delays that are so extensive that they can actually shift the year that forgiveness actually occurs. So what we're seeing right now with borrowers who reached forgiveness eligibility after April 2025 is we're seeing that they are stuck waiting due to processing backlogs. That delay might be temporary, and so years from now, we might not see delays like that, but this just highlights how hard it can be to plan around a specific calendar year when we're thinking about the tax bomb. Another major concern and question we get is, what if I don't have the money when the tax bomb comes due? If you reach forgiveness and you're not prepared financially, that is something that we should talk about here. So no one has had to pay a tax bomb yet. So as far as we know at this point, we would expect it to be treated like any other debt you owe the IRS. So at tax time, if you don't have the money that you owe the IRS, you can go on a payment plan. And so they may offer a payment plan that would have some interest that would accumulate on it. Of course, nobody wants to owe the IRS money, and certainly nobody wants to owe the IRS money like $100,000. And so it's better to plan ahead for the tax bomb and not have to worry many years down the road about owing the IRS money. There is something called an insolvency exclusion, but it is often unrealistic for veterinarians who have a stable earning potential and are investing in retirement and, of course, doing all of the other things that they do with their money over time. And so it's going to be harder to qualify for insolvency than many people assume. And it's something that's highly fact specific. That's not something I would rely on. Jason Ballara, who is a surgeon and real estate investor we've interviewed on the podcast previously, he's got a really helpful analogy. So forgiveness functions a lot like winning the lottery. You have to pay taxes on that money. Having a plan ahead of time, of course, is going to give you a lot more flexibility versus waiting until forgiveness arrives, and that's going to really limit your options for what you can do. An important exception for folks who might be receiving forgiveness or should have received forgiveness, I should say, in 2025. So there's an important thing to be aware of there. If you were expecting to get your loans forgiven in 2025 on like a 25-year repayment plan like IBR or ICR, those folks who were supposed to receive forgiveness in 2025 but are delayed due to Department of Education backlogs probably won't be required to pay a tax bomb because of those delays. So there was a preliminary agreement tied to some litigation involving the American Federation of Teachers, where the Department of Education stated that it will not issue that 1099-C to borrowers who were eligible for forgiveness but had their applications delayed due to processing issues. That allows those borrowers to avoid a surprise federal tax bill when filing after January 1st, 2026. So this is a narrow situation, but it's important if it does apply to you. A quick reminder about public service loan forgiveness. So I mentioned it earlier. PSLF remains federally tax-free. And so that has always been the case. That hasn't changed. And the vast majority of states will also grant public service loan forgiveness tax-free as well. All right. And so planning for the tax bomb comes down to understanding timelines, realistic projections for how much you might owe, and also how student loan decisions interact with taxes and investing over time. As repayment plans change, you're going to want to make sure that you revisit those projections. You'll also want to make sure you revisit those projections if you have significant income changes that are long-term as well. When the projections change, the preparation strategies and as far as how much you need to save etc., often will need adjustment as well. So this is something we help vets with on a regular basis, and it's often more manageable once the uncertainty is replaced with clear numbers and a plan that is coordinated with your overall financial plan. Thanks so much for listening. Our mission is to help you take control of your finances and build a life you love. If you'd like help with your student loan plan and the tax bomb, or if you'd like to see how financial planning can support your goals overall, visit allvetfinancial.com and click the Book Now button to schedule a free intro call. Until next time, take care and continue your path to financial success. This podcast is for informational and educational purposes only and should not be considered individualized financial advice. If a specific investment is mentioned, it should not be considered a recommendation or endorsement to buy or sell the investment. All investments involve risk. Past performance does not guarantee future results. You are encouraged to seek the advice of a financial professional before implementing any investment strategies discussed. Yay, compliance!